welcome from Trend Signal for our review of the data and events the week beginning the 14th of March. First of all, just like to point out that US clocks have gone forward, so they've had their adjusted for the summertime, so there now is just a 4-hour difference. That basically means all markets in the US and all the data releases, etc., will happen an hour earlier. So, for example, stock markets in the US will close at 8 instead of 9 p.m. and will open at 1 p.m. or 1:30 p.m. rather than 2:30 p.m. We actually put our clocks back here in the UK and in Europe on the 27th of March, so the regular 5-hour difference will be we'll go back to that on that particular day. Overnight news on Monday morning. Far East markets very steady post European Central Bank volatility spike, as it were. European markets certainly continue to recover after the events of last Thursday, whilst the euro put an extraordinary reversal on the day after Mario Draghi suggested there would be no further rate cuts. Certainly the stock market has recovered. The DAX shed anything up to 600 points from the high on Thursday, but as we talk on Monday morning, it is close to those highs it achieved right after the announcement on Thursday lunchtime. So a bit worrying about the liquidity in the markets, of course, that allowed this to happen, but that's another issue. Overnight as well, Angela Merkel suffered, I guess what you'd say is an inevitable setback in regional elections in Germany as the right-wing anti-immigration Alternative für Deutschland party, I guess you say, could send the most obvious of messages about the open-door immigration policy that Merkel's government put in place. However, as I have already mentioned, markets have not really batted an eyelid as equities and bonds remain firm this morning. Markets struggled a little bit last week, although risk-on mood does persist. As I said, Mario Draghi delivered on the rumours, certainly more than it was expected at least, and the euro, along with equity markets, reacted as you'd expect on such measures. But by the close, the euro had surprised most observers by turning around a significant loss to post one of its biggest gains. And I think the turnaround, in fact, on the euro was one of the largest ever snapbacks in the euro since its inception. Well, the question is why. The short answer, I guess, is that there's no fundamental reason for this move as ever in such circumstances. The answer is more technical. I guess major players were on balance short the euro as you'd expect. They were expecting the ECB to deliver, and the ECB did. And I think the ECB and Draghi, I should say, were hoping the euro would respond. But unusually for Draghi, he did put his foot in it a little bit by stating that there will be no further rate cuts, and I think the market lives on expectations, so the euro rallied and equities fell. I think this is probably a temporary blip to a certain extent, and I expect the euro will start to lose ground more in the coming weeks in the face of this extra QE. But as I said, the reaction was a little bit worrying in the market, certainly worrying for the regulators, because the real reason for these violent swings was lack of liquidity, really. Certainly not enough to stop the euro snapping back over 150 points at one stage on Thursday by about just over in 5 minutes. So that's a really violent swing, even in the nightmare days of the financial crisis, to be honest. So let's have a look at the data and events coming out this week. It's more central bank feedback, more rate decisions this week from Japan. The US is the most notable one, obviously, as always is. The UK, we have our own MPC reporting, Switzerland and Norway, and a bit of unemployment data, inflation data and consumer sentiment readings. And for us here in the UK, we have our annual budget statement from George Osborne. That's on Wednesday at approximately 12:30. There's no a definite time, but that's when it takes place and should last about 60 to 80 minutes, depending. So last week we had the ECB really surprising us with a bigger dose of monetary easing, and we don't expect anything from the other central banks really. I'll get on to the FMC in a minute. The one possibility is the Norwegian Central Bank. If you follow that one, looks like they may well cut rates as economic growth has been weak so far this year, coupled with a big downward revision of GDP in 2015. So that's a possibility. In terms of Switzerland, the Swiss National Bank, they tend to catch the market with the odd surprise as witnessed in January last year. But I think the reaction of Euro Swiss was not too great, so I don't think they've got any reason really to do anything on Thursday. But really it brings us on to the most important event of the week, which is the Federal Open Market Committee meeting. Statement on Wednesday. It'll be at 6 o'clock. Remember, the difference in time is only 4 hours now, so usually it would be 7, but it's actually at 6 o'clock this time round. And it looks like, certainly projections are for the Fed funds rate to shift down a little bit. Most economists were expecting around 1.375 by year end. They pared that down to 1.125 now. We expect Janet Yellen to confirm that the next rate rise will still go ahead in June, although I seem to recall back in December after the first rate rise that March would be when the second rate rise would happen. Just goes to show you. So the unforeseen shocks or circumstances tend to happen more frequently. Witness August last year and January this year. Other than that, the UK budget is very much a local affair, as I've pointed out. We expect to get another small dose of austerity, which tends to go down quite well with the markets, actually, and certainly sterling. I think the noise coming out of the Treasury and from George Osborne suggests there's another mini dose, specifically a rise in fuel duty, which I guess with the collapse in oil and petrol and diesel was always going to be pretty likely. Potential effects are difficult to gauge. Sterling's already rallied some 5 cents off its lows versus the dollar, so further strength as a result of any budget news. I guess it's probably unlikely, but time will tell. Let's have a look at some other data out this week, apart from the central banks and our budget here in the UK. Tuesday in the US, we have retail sales, core retail sales, slipping again in the US. Negative 0.2% is the expectation. We also have PPI, that's Producer Price Index. That's the cost of goods and services going into production. No forward warning there on inflation at all. Also negative 0.2% from plus 0.1% last month. So very, very benign indeed. We also have some manufacturing data out in the US out on Thursday. The Philly Fed Manufacturing Index, Philadelphia being one of the bigger manufacturing districts that the Fed reports on. So the manufacturing index is followed quite closely. A slightly better number than the previous month, but nothing too much to write home about. And then we finish the week. Again, remember the time is still 1 hour different from normal. 2 o'clock in the afternoon, we have the preliminary reading for the University of Michigan on consumer sentiment. Nice to see, 92.1 expectations, so slightly better and still very strong for consumer sentiment. I guess the rebound in equities from January's swoon has helped steady the consumers' nerves, and obviously consumer sentiment is key in the long run for the US economy, so that number is quite closely watched. And that's it. Thank you very much for listening for now.
If you would like more information about trading the right way, Trend Signal is giving you the opportunity to see and hear about its services live at a free online seminar. Take a look at the Trend Signal website for the latest events and to book your free place.